Hello and welcome to episode 5 of the New Trader's Playbook. In today's episode, we're going to be talking about something that is extremely important when understanding how the market works, and that is the fact that the middle runs the market. So today, we're going to take a look at something about our candles and our wicks that is extremely important to understand so that you can set yourself up for success when you start trading in the market. So let's take a look at our first picture here. Now, one of the things that we have identified as important to us is the fact that we know that there are highs and there are lows. Now, in this case, we've got our wick right here. So we have a high of the wick and a low of the wick, which, as you can see, coordinates to these two levels. Now, whenever we have a high and a low, we also have what we call, that comes right in the middle. We have our mid level. That also, if you were to think of this in almost like a Fibonacci type style, you would have a 0% right here and a 100% up here. The middle line is going to be your 50%. This number is going to be essential for understanding how the market moves and why it does what it does. Now, in this scenario, you can see we've got our 50% up here. We've also got our high, low, and our mid, which is what we'll refer to this in this series, the mid. Now, on the other side there, you'll notice these dotted lines have been drawn in the middle of these wicks. This wick, and these two up here. So what we're seeing is that price loves, just like we talked about last week with the center or the areas that are fair value gaps, or maybe the price gaps in price, any kind of gap that acts as a magnet, you're going to see the exact same thing when it comes to these 50% middle levels. Price likes to come up, and then maybe you'll see it come to this spot right here, which is represented by that 50%, and then it'll retrace back down, and then it'll come to another 50%, and then it'll retrace down, and then it'll come to another 50%, as you can see within on these dotted lines. Now, one other thing that you might see is that these are oftentimes referred to, depending on where you do your research about trading, it's referred to as the CE, which was a terminology that was created by a trader called the Inner Circle Trader, very well known on the internet. But it was the first place that I ever found my knowledge of how strong and how important the center line is. So CE stands for consciential encroachment. Now, does that name matter? Not one bit at all. It does not matter. But what matters is that we understand that the CE is the middle of whatever we're referring to. Now, remember, the middle is going to refer to either wicks or bodies or entire candles. Okay, so it can be any of those, but the middle levels are going to be really, really important for us to focus on. Now, one of the things that we need to think about is the fact that there are two major levels of importance inside of any wick. Okay, so we're talking about wicks. We love our wicks. They're really important, but there are two different locations that are essential for understanding the importance of how price is going to move. Okay, so the first one, let's take a look here. Here is our wick, right? So we've got this, we've also got our middle level there in the middle of the wick. So price may stop here, right, in this candle, and it may go up, and then it's gonna come down in the first location that we would call our point of interest, or the first problem spot, as my mentor likes to call it, would be this one right here, which is represented by the open of the candle. Okay, so the first space that you may see on any given candle that becomes a problem spot, that becomes a good spot for reversals, or at least this location where price might stutter step, it may hit it and then decide to turn around, is going to be the open of that candle. Sometimes price is going to come up and down, hit the open, and then make its move. Now, when it doesn't hit the open and it wants to continue a little bit farther, what we're going to find is our second location that we talked about, which is our mid, right? The middle level of that specific wick. These are two extremely important locations, okay? So I want you, when you are taking a look at the charts, when you are observing things, I want you to focus in on what's happening at the middle of the wicks, what's happening at the openings, because really we've got an opening right here, we've got an opening right here, and if you'll notice right there, in this specific example, price hits the open of this red candle, this bearish candle, and then immediately falls to the ground. So we want to be able to focus on why is price doing what it does. One of my favorite things is looking at price and then saying, what was the reason for it turning around? What was the reason, as we've mentioned before, look left, right? What was the catalyst that caused price to reverse, turn around on a dime? These are extremely important for us to understand if we want to have a chance to get into the market at the right place, the right time to take those trades and capitalize on big moves. Now, let's take a look at our next one. This is the same concept, but if you'll notice, we had quite a few different things happen here. Price comes up, we get to hit our open. Price moves down, we get a nice long wick. Remember, important, look to the left, what happened? There we go, we're filling in areas, so there are no gaps left. We're getting past the open, but maybe we're getting right there to that wick's middle, right? Maybe we'll wick middle again. Then price will reverse and we'll wick middle again. These are just things that you want to notice, because what this means is just like what we were talking about last week. Price is balancing. That's so important. Price will continue to do a balancing act as it moves from one location to the next location. And we want to be keen on how price balances and how it makes its way to the next location. Now, this is an interesting one. We're going to take a look at this not only on these charts, but also on our actual trading view charts. So I want you to imagine that this is a 1-day candle. So we've got our 1-day candle, and as we've already seen, the candle obviously started here at the low, made its way up to the high, and of course we've got our close and our open. And for the entirety of the candle, here is our mid. There's our location. Now, what price loves to do, and you will see this all the time. Now remember, price is fractal, so it does not matter whether we are looking at a 1-day chart or we are looking at a 1-minute chart. It doesn't matter. What does matter is that we see patterns within the movement of price and we capitalize on them. So one of the things that I really love is when a day closes, like you see here, and then over to the side, of course, we have our open candle, then we have our high. So what price did is when the following day opened, price went straight up and it crossed the high. Now, if you'll remember from our last episode, that now makes this a 2-up candle, right? Because it crossed the high, but does not cross the low. So what ends up happening in this candle is we open here, right? And then we go up and then take out the high. Then we come down here, hit the low, and then close. That's how that candle was formed. But why is this so important? In scenarios like this, price loves to take out the top of the previous candle, reverse all the way down to the middle of said candle, and then turn right back around. Why do we need to know this? Because you can take some of the most wonderful trades for reversals at locations like this, or possibly, depending on how the trade formed up here at the high, up on top. Now imagine that. You can take your trade short all the way down to here, or long all the way back up to the top. Now, price is not that simple. Trading is not that simple, but it is important to realize that we want to know what is to the left. And in this scenario, to the left is the middle of the previous day or previous hour, previous week, month. It doesn't matter. It's all going to work and give you a good idea for a location that's going to make your trades a whole lot easier. Trading the right place, the right time, location. All of those are extremely important so that we're not trading all over the place. The market. It loves to balance itself, all right? Now, what might that look like? Because technically, price is going to do one thing. It's going to start from point A, and it's going to end up at point Z, all right? A to Z. Now, what price does not do, it doesn't go straight from A to Z. In very rare occasions, maybe like news days, but price does not go straight. Price likes to go from A, and then it'll go up, and then it'll go a little farther, and then it'll go a little farther, and then a little bit farther, and then it'll make its way to Z. Now, why does this matter? The reason why the mid is so important is because in price's decision to balance itself, one of the strongest locations for balancing has to do with a retracement, a pullback into half of the previous area's distance or length. So take a look at this area right here. Let's say this is your move, your low to your high. All right. Price makes a pullback. Where does it make its pullback to? Somewhere around the halfway point, the mid. Price goes again. Here's your low. Here's your high. Pulls back. Where does it go? Roughly to the halfway point. Now, is this how price works all the time? Of course not, because sometimes price goes up and then down and then up and then all the way down and then it sometimes does a little bit different dance. But the point is that the market loves to balance itself. If we can keep in mind that maybe instead of trying to take trades right here or take trades right here, maybe we wait until we get to these spots. Maybe if we want to be long, if we want to get into a trade, we want to enter, we want to wait until price has decided it's in the right location for us to be interested. Remember, a lot of the times when it comes to trading, the most important part about getting into a trade is finding a good location to enter. I don't want to go long at the top. If you remember a couple of episodes ago, we talked about these trend lines, right? And if I find that price, for example, like we talked about before, if I find that price is trending along a line, right? Maybe it's hitting the tops of these. If I see that, well, maybe when I get to this spot, I don't want to go long. I don't want to buy that product, but I do want to buy it because price is in an uptrend. So I'm going to wait until it comes down to a logical location. Then I'm going to find an opportunity to get into that trade, using the market's balancing act to make sure that I get a good price on my order, so to speak, and making sure that I can get in at the right place so as to not trade in a way that I'm buying the tops and selling the bottoms. We never want to do that. So let's take a look now at a couple of things that I think were the things for me that really changed the way that I looked at the market. So I'm going to take you to something interesting, maybe something you've never seen before. This is a 12-month chart. Remember, the market is fractal. And what that means is that everything should work on every time frame. So we've been looking at 1 minute, we've been looking at an hour, 4 hour, a daily chart. Now we're going to look at a 12-month chart, which means each one of these candles represents a 12-month chart. Each one represents a different year, as you can see, 2020, 21, 22, 23, 24, 25. Okay. So as I mentioned, this was one of the first things that convinced me without a shadow of a doubt that the market is run by an algorithm and that we can learn the algorithm if we just know where to look. And the fact that the market is run by these middle levels, these middle retracements have so much power, it's something we need to focus on. So what I'm going to do is use this tool right here, which this tool offers me, as I talked about before, a 0, 100, and a 50. So what we're looking at is a 0, 50, 100 tool that will allow us to see the exact mid of any location. So last week we talked about fair value gaps. So let's take a look at what happened as of 2020. So in 2020, created this big up move, and 2021 created a higher candle. We were left with what we had seen before as a fair value gap or gap. Now, here's the top of the previous year's candle. Here's the bottom of 2021. If we use our fib, bring them from one to the other, we are able to look at the middle level of this gap. Do you notice what happened right here? Take a look at that. Price within 2022 came all the way down and hit perfectly into that middle section. That's what we're looking at, right? This is why we know that there's an algorithm, because price moves beautifully. Now, at the beginning of that year, what happened? So here's 2021. January 2022 hits. See how they had that little tiny wick up there at the top? Well, look what happened at the beginning of the year. Beginning of 2022 opens right there. And then you see how beautifully price raises right here, right to that mid level. Wick mid, right? Price likes to balance. The market likes to balance. And we're talking about full years. We're not just talking about a couple of minutes. But once again, the market is fractal. That is what is most important to understand. So price comes up in 2020, 2021, 2022, hits our wick CE or wick mid right there and falls out of the sky. Where does it stop? Well, it stops perfectly at the gap's middle level. Beautiful. Okay, so that's 2022. What happens in the next year? Let's move over a little bit. Let's take this to the close of 2022 and the low of 2022. What do you think about that? Absolutely gorgeous. When we got into 2023, price came down and it perfectly tapped, chef's kiss, the middle level of the wick of the previous year. You see how easy it is to understand that price is not random? You see how easy it is for us to see that this is not something that's being caused by a bunch of people buying and selling, but this is the algorithm showing its hand. Imagine what it would be like if you're an investor, maybe, to be taking trades here, maybe your stop loss underneath here, and look how much the entire year, nothing but up. The entire year, nothing but down, right? These are extremely important concepts. And this is what really convinced me, even this year. Yeah, 2024 was straight up in the air. We didn't really do much. We didn't have, this small wick was invalidated straight to the top. But what happened this year in 2025? At the beginning of the year, we had a huge down here on the NASDAQ. But where did it go? Yeah, it went a little bit farther. Didn't go below the low, though. You notice that? So we're looking at things that show us that price loves the middle, right? It loves the middle. So let's take another look at something. This is still NASDAQ, and I'm going to use some of the indicators that I love. And if you're interested in taking a look at some of the indicators, if you have picked up your TradingView account, you can get access to a 3-day free trial of these from the Key Levels Pro. And all of that information can be found on my website there at the bottom, dreamindicatorsandtools.com. But what we're going to take a look at are some of the prior day levels and how they are so beautiful when it comes to reversing on the halfway points. So the first one we're going to look at is prior day. So what you're looking at with these lines, as you can see, the red one is the prior day's high. The orange one is the prior day's mid, and this one is the prior day's low. Now I want you to think about what's happening here. We've been discussing the middle line. So the most important part here is our orange levels. But I want you to notice what's happening when price decides to make a move and where it's pivoting. This was a beautiful example. You notice how here on this chart, this was a few days ago, price immediately gave us that 2 up. You remember, we just talked about that. Here's a daily chart. We're looking at the 1 hour, but these lines refer to the day. Yesterday, this was the high. Today, price goes above the high. Where is it magnetized to? right to the middle, just like we talked about. What happens after we hit the middle? We reverse, and eventually into the following day, we head right back up to where we were before. These types of moves happen all the time. You can see we come up from underneath the previous day's low. We get up here, a little bit higher. That's okay. And then price falls, right? Imagine being able to trade, invest, look at the previous day's levels and see what kind of bounces we can make. Where can we go from the previous day's high back to the mid? How can we sit here for a little bit and then go back to the low? What happens when we get above, come down? There's your previous day's mid, like a trampoline, jumping straight up in the air. But it doesn't just stop at the previous day. What about the previous week? So now what you're looking at is weekly price. Here is the previous week's low. That was last week. Here's the previous week's high and the previous week's middle. You noticing what's happening on these levels? Price is pivoting off of this previous week's middle level. It's beautiful. It's absolutely beautiful. Price is pivoting. And then when it breaks, because of course we know that that happens, remember, support, resistance. We talked about that a few episodes ago. Price will bounce on these levels. Can you imagine being able to capitalize on some of these levels, bouncing, 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 bouncing? These are the types of things that we have to focus on. They're also the things that convince me and have always convinced me that the market, it loves to balance itself. And the middle levels are essential keys to your long-term success. So thank you so much for watching episode 5 of the New Traders Playbook. And I hope you enjoyed it. If you liked it, please feel free to like, subscribe, follow, share, and we'll see you in the next episode.